Okay, so I've started recording for this class. I handed out the chapter 9, part 1 handout, and so it's got a few questions on there. Take about 3 or 4 minutes, and we'll go over those afterwards. Hello, Kelly. Please let me know if for any reason you can't hear anything, but otherwise you are welcome just to hang out. We're doing the practice questions from the handout number 8. Okay, so let's go ahead and talk about these. So which of the following is not a major characteristic of a plant asset? And it possesses physical substance. That's true, right? It has to be something physical. Acquired for resale. So that one would not be what would be considered property, plant, or equipment. Something acquired for resale would be considered. You could carry it as an investment. The other thing you could be is inventory. So could be in as one of those two. When computing, the amount of interest cost to be capitalized, concept of avoidable interest refers to. And so this is interest presuming if you didn't have the project that you wouldn't need to borrow the money. So it's that portion of total interest cost that would not have been incurred if expenditures for the asset construction had not been made. Fences and parking lots are reported on the balance sheet as good land improvements. When boot is involved in an exchange having commercial substance, boot being some sort of cash, gains or losses are recognized in their entirety. In which of the following situations would a cost incurred after an asset's acquisition be capitalized? So here you have to think, am I extending the life of it significantly? Am I changing the value of it? or am I changing what the asset is? And so there's no increase in the useful life of asset. That would not fit under that criteria. The expenditure is necessary to maintain the working order of the asset. That sounds a lot like maintenance, right? The amount of the expenditure must be immaterial. If it's not material, then we would just expense it, right? And so the last one would be the useful life of the asset increased. Any questions on those five? Okay. So let's go ahead and jump into property, plant, and equipment. Okay. So this is going to be notes, but these will be here. So keep in mind if you fall behind or you have a question, you know, these will be on here, but if you need me to stop at all, please let me know. Okay. Property, plant, and equipment. That distinguish from other assets in a business. Where I put that bar, it's always in the way. And so it's acquired for use in operations. And just that's just a reminder, not for resale. Long-term in nature and usually depreciated. What would the exception be there? Right. Land. No depreciation on land. Value changes. If it goes up, we get to recognize it when we sell it. If it goes down and it impairs the asset's ability, then we'd have to do an impairment test and potentially write it off. But there is no depreciation on land. And then we know possesses physical substance. Property, plant, and equipment is also called fixed assets or non-current assets. And we report PP&E at historical cost. Plus capitalizations. So what makes up the historical cost for property, plant, and equipment? One is the purchase price, plus any taxes. Most of the time businesses don't pay taxes on that type of stuff, but it varies. Freight or shipping costs paid by buyer. Okay, and then the last part is that costs to prepare for intended use. And this would be installation, testing, etc. Make a little note here. Historical cost does not include abnormal expenses. Repairs for damage prior to installation would be one of the examples. Any questions there? Okay. I mentioned PP and E cannot be written up for gains in value. Unless there is a plan to sell the asset. So if you end up deciding to sell an asset, you have to update the depreciation and then you can adjust it to the fair value. But in general, they cannot be written up. I already talked about that it can be written down. We already talked about costs that extend the life of an asset are capitalized. I'm now going to list some costs associated with the PP&E category. Land improvements. These are costs of structural additions to land, make it ready for use. Don't confuse this with preparation for a building. So if you are preparing the land for a building, that cost will go into the building. But if you are just planning improvements, parking lots, fences, etc., like that for it, then that gets categorized as land improvements. Land cost includes purchase price, closing costs and fees, preparing the land, assumption of any liens, mortgages, or encumbrances. Sometimes towns and counties will sell land and they'll say the sales price is basically nothing, but you've got to pay the back taxes on it, and then you've got to get it up to code. So if that's the case, those costs would be included. And any land improvements that have an indefinite life. Bless you. Land does not depreciate. But can be written down if the value is impaired. Equipment cost. Purchase price. Assembly. Installation. And training. Shipping costs paid by the buyer. And any facility costs necessary to prepare for the equipment. So for example, if they were deciding to use this room as a video room and they were going to come in and redo the space and put in new cameras and video equipment, any of the costs to prepare this room for those equipment would go into the capitalization of that equipment. And then the last big category over here would be building costs. And so, extra G there. And so you have the purchase price, or the cost to build. If constructed, materials, labor, and overhead are charged to the building. Building permit fees and taxes. Interest on construction related debt. And architect and attorneys fees for related services. Okay. Any questions before we jump into example one? Okay, Previn Brothers purchased land at a price of $27,000. So we have the purchase price equals $27,000. Closing costs of $1,400. And an old building was removed at a cost of $10,200. So it's 10,200. And so we add up those totals and we get 38,600. Now, if they said an old building was removed in place for a new building, they would probably capitalize it as part of the building. But since they're just cleaning up the land and they don't have a specific intent for it now, they can't do that. Take a look at example 2 and kind of just go through and put a little L or a little building on which parts you think should be related to which one. I'm not going to question you on this. I'm going to go through afterwards and talk about each of them, but let's just see how comfortable you feel. So I'll give you about 3 minutes to do that, or 2 minutes, and then we'll go from there. Okay, so what we want to try to do here is separate out which costs are sort of related to the land and just preparing it, and which costs are going to be related to the building. So we purchased land as a factory site. And so here, that's going to be categorized as land for 400,000. Payment to raise old buildings. So we're, again, still preparing the land, 42,000. Sale of salvage lumber and brick from raising. So this is going to reduce the cost of the land. So 6,300. Legal fees paid for the title investigation and drawing the purchase contract. So this would be just for the land at this point. So that 1850 goes into the land. Payment to an engineering firm for land survey. Survey had to be made before definitive plans could be drawn. Now, here, what they wanted to realize is they're saying, okay, we're doing definitive plans. for something else. And so they want you to allocate this survey to the building. Payment for drawing the factory plans, excuse me. That's for the building, so 68,000. Title insurance on just the property. So that would be on land for 1,500. Liability insurance premium during construction. It sounds like they're already starting to build the building, so that would be 900. Contractors charge for construction. $2.740. And these are payments, and so they don't change anything. And so we don't include those, right? Because those are just the payments for what we owed. And the interest cost to finance the construction, that 170,000 there. So I get 439,050 and 2,981,100. I didn't realize I had that second lid on the whole time. So why, if you're a manager and you're being evaluated based on performance, where would you want to allocate most of this stuff to? So think about your logic there. If I allocate it to the building, then what do I have to do with it? Right, which is an expense that is incurred a little bit going forward, right? If I put it in as land, if I can get some of these costs into the land price, what happens then? It doesn't depreciate, right? And so you're not reporting an expense during those years. Now, if you did it so heavily that you caused the land to be impaired in value, well, obviously that would be a problem. But in general, land usually has quite a bit of sway in valuation. So if you're a manager, kind of want it to go to land, but you have to follow the rules. Any questions there? Okay, you got a little space up above, and we're going to talk about asset retirement obligations. And so this is just some assets may require that nature or the surroundings are returned back to an untouched condition. When that occurs, the company must record a liability if they can estimate it accurately. caught a story on the news the other day, and we've started to have obligations for oil companies and well companies. And I'm not going to remember the last number, but there are thousands of wells that have been left open in Texas and around the country. If you take the country, it's millions. And so something like this would normally be budgeted in now to repair those wells. So the company estimates the liability by taking the present value of the fair value of the estimate. Then the company accretes the difference using the effective interest rate method to increase the ARO over time. So liability estimated cost at retirement date. So just to quickly throw some numbers in there, just so if the company expects 2,000 of cleanup 10 years from the future, they would use the present value method at their borrowing rate or similar borrowing method. And so let's just say for easy calculation, let's just say 150,000. Then the 50,000 difference is accreted over the 10 years using the effective interest rate method. What have we been doing mostly when we're trying to allocate something over a number of years? We normally just divide it and say, okay, that'll be 5,000 a year over X number of years. But here with this one, they want you to use the effective interest rate method to allocate it. And so you'd have more allocated in the later half. All right, so let's look at some examples. Company determines that it has an asset retirement obligation of 100,000 related to underground tanks for a gas station it purchased in January 1, 2025. The gas station tanks have a useful life of 10 years and are depreciated using the straight line method. The present value of the ARO liability using a discount rate of 6% is $55,839. So what entry should we make to record the ARO and the ARC for Hillman in 2025? So what we do is we don't report this as an expense. We report it as part of the asset. So in this case, gas station would be our asset. And then you'd have a credit to asset retirement obligation for the gas station. And so they said the present value of it is $55,839. So now it says it uses straight line, which if it's not material, GAAP doesn't care. If it's material, then GAAP would care and say you have to use the effective interest rate method. But here we take 100,000 and we subtract the 55,839. And so that is, let me pull up my calculator. I heard somebody say 44,161. Okay. Okay, so the first part of the entry sorry, what do we have here for, this is 10 years. Hold on one second. So they want to do two separate part entries here. So 55,839 is the asset liability. And so we need the depreciation. And so we have 55,839 divided by 10. And so that equals 5,584. And this is your annual depreciation. And so this would be depreciation expense and accumulated depreciation for the gas station. And so that's the 5,584. And so now we have to make the calculation on the remaining using the effective interest method. So 55,839 times 0.06, which is our interest, our liability using a discount rate of 6%. And so that equals 3,350. And so here we have accretion expense and asset retirement obligation for the gas station. And that's 3,350. So you have to do two parts. One, you have to depreciate it. And then also you have to accrete the obligation so that it's at 100,000 when we retire this asset. So a little note here. I want to remember that the adjusting entry requires two parts. The depreciation for the asset retirement obligation portion and the accretion of sort of discounted amount. Okay, any questions there? Okay, so let's look at example number 4. Schultz Department Store determines it will cost $100,000 to restore an area considered a land improvement surrounding one of its store parking lots when the store is closed in 2 years. It estimates the fair value of the obligation as of December 31st, 2025 is $84,000. Prepare the journal entry to record the asset retirement obligation. And so this would be land improvements, 84,000, and asset retirement obligation for land improvements, 84,000. Any questions there? Okay, let's look at example number 5. Caliph Drillers erects and places into service an offshore oil platform on January 1, 2025 at a cost of $10 million. Caliph estimates it will cost $1 million to dismantle and remove the platform at the end of its useful life in 10 years when the company is legally required to do so. The fair value at January 1, 2025 of the dismantle and removal cost is $450,000. So relatively straightforward here again. Debit oil rig and then credit asset retirement obligation for the oil rig. And that would be 450,000 and 450,000. Any questions there? Okay. Now, when we talk about these rules, remember, we're talking about if these are material, right? So it has to make a difference to the company in order to be bothering with this stuff in the way that we are. If these are small amounts, most of the time they're likely expense. But when we're talking about big things, we can talk about it costs significant amounts of dollars to build a building. You know, you think about out there, what's going on now. That process, I think, is expected to take nearly 1.5 to 2 years. And so it takes a long time. And in order to get that thing started, you've got to have either the money or you've got to borrow the money in order to do that. And so it can be substantial, right? I think that building is going to cost out at somewhere around $54 million when it's finished. And so, you know, over time, if you have to borrow 5, 10, $20 million, which I don't know the situation here, I don't know how they're funding it. I'm not saying that's what's happening. But if you do, that can be a considerable amount of interest that gets capitalized. You know, it could be a couple $1,000,000. So it may matter to a company, and it can be material. So interest costs during construction, capitalize interest costs incurred in connection with construction in progress. And the rationale is this is consistent with capitalizing all costs incurred to bring the asset to being ready to use. It's terrible English. Okay, qualifying assets. Assets must require a period of time to get ready. Months, years. And so which assets qualify? Assets under construction. Buildings, factories, large machinery, qualify, and assets intended for sale or lease. That are produced as separate projects. So if you're producing special order boats and it's going to take you 6 months to 2 years to do it, then you can charge the interest to that inventory, even though it's going to be sold. But what you wouldn't do is if there are a bunch of products that you just normally make and they're all the same, you wouldn't capitalize that on your inventory. The period begins when three conditions are met. The first condition is expenditures for the asset have been made. And this could be a deposit or so you could have already put a deposit down. You could have already been making expenditures. Activities necessary for asset preparation are in progress. Interest costs are being incurred. The amount to capitalize interest capitalization is limited to the lower of actual interest costs incurred for the construction period or the amount of interest that could have been avoided. If there was no construction. Companies calculate a weighted average of expenditures, and this would be costs towards completion, by the amount of time that the expenditure would be incurring interest. So think about this as adjusting for partial year. It's going to say, like we do with common shares outstanding, but you guys would be like, huh? That's the other class, dummy. Give you guys time. Finish that up before we jump to the example 5. Assume that Tesla contracts to build a tram for its Nevada Gigafactory, which is expected to be completed in 17 months. The current year payments to the contractor are $240,000 on March 1, $480,000 on July 1, and $360,000 on November 1. How would you compute the weighted average accumulated expenditures for Tesla? So we have several different amounts. They gave us 240,000, 480,000, and 360,000. And the capitalization period, in this case, you had January, February expired, so this is 10 of 12 months. This is 6 of 12 months. And then November and December is 2 of 12. And so all we do is multiply those across. So 200,000, 240,000, 60,000 gives us a total of 500,000. And so the capitalization period is equal to the months between payment and the end of year, or when the asset is put into service or sold, whichever is first. So I'll take a look at number 6. Hanson Company is constructing a building. Construction began on February 1 and was completed on December 31st. Expenditures were $1.8 million on March 1, and $1.2 million on June 1, and $3 million on December 31st. So this one's easy, right? Last day of the month, your capitalization period is 0. Here, January, February, we're not part of it. So we have 10 of 12 months. And here, 7 of 12 months because it was June 1st. So we multiply these out and we get 1.5 million and 700,000 for a total of 2.2 million. Now, is this the number for your interest? No, that's the expenditure that you're going to look at and say, okay, what are my borrowings that are related? And you're going to use that either in tranches and say, okay, I have multiple levels, or you're going to use an average level of your debt to get your interest that you can capitalize. But this is just how much your accumulated expenditures are that you're going to be able to use towards applying the interest. Okay. Hanson Company borrowed $1 million on March 1 on a 5-year 12% note to help finance construction of the building. In addition, the company had outstanding all year a 10% 5-year $2 million note payable and an 11% 4-year $3.5 million note payable. Compute the weighted average interest rate used for interest capitalization purpose. Okay, so we said we have a 10% note. $10% 5-year note for $2 million. And $3.5 million on the principal. And so it says total wise, 5,500,000. This is 0.1, right, for 10%, 0.11 for 11%. And so we calculate the interest. So the first one would be 200,000. And the second one would be 385,000. And this would be 585,000. Now, why didn't we put the other one in here with this? Because there's really 3 notes, right? Because that one is specific, borrowed 1 million on March on a 5-year 12% note to help finance the construction of the building. So that one is directly tied to the building. So we don't have to look at our other borrowings for that. And so if we wanted to compute the weighted average interest, all we do is take the 585,000 and we divide it by 5.5 million. And that equals 10.64%. So expenses up to 1 million would be at 12%. Expenses beyond 1 million be at 10.64%. Okay. Okay, for interest rates, remember, multiply the weighted average accumulated expenditures by the portion of the weighted average accumulated expenditures less than or equal to specifically borrowed for construction. And then you would add that to the portion of weighted average accumulated expenditures that exceeds the specific funds borrowed for construction. Use the weighted average interest rate. Other debt. And our last example for today. Assume that Tesla did not finance the cost of the tram with a specific loan. Instead, it used weighted average of its debt outstanding. Here's how Tesla determined its interest rate using the following information. So we have a 12% 2-year note. That principal is $600,000. The interest, 12% of $600,000 will be $72,000. 9% on 10-year bonds, this is $2 million. And so the interest, 9% of it is $180,000. And then your 20-year bonds, $5 million. And the interest is $375,000. So we take our totals, $7,600,000. And our total $627,000. And we plug it into our formula, the weighted average interest rate. Total interest divided by total principal. So $627,000 divided by $7,600,000. And that equals 0.0825 or 8.25%. Yes, I got one more. I apologize. So I'm keeping you here for one more. All right. Given. I think they're given. I pulled them from another example, but they're just given. I'd like to tell you that I didn't make them up, but I probably did. Okay. So now use the information from Hansen Company, example 6 and 7, compute avoidable interest for the Hansen Company. So we had weighted average accumulated expenditure. So we're going back to example 6 here. And we're looking at what are my weighted average accumulated expenditures. And we have $2.2 million, right? And so number 7 says we have $1 million loan. And so that's going to be our first one. And so we have 1 million times our interest rate is 12%. And so that avoidable interest is 120,000. And then we have the remaining 1.2 million. And that we said would be 10.64%. And so that interest calculation is 247,680. Nope. Read the wrong line. My apologies. 127,680. So we add these up and you get 247,680. And this would be the amount that is avoidable. and could be capitalized. And then just a little reminder, this is interest that would be avoided if there was no construction. And remember, interest costs for preparing land for a building get charged to the building. And then the other thing to remember is if the company invests some of the borrowed funds, the revenue should not offset the interest expense. I don't know why. Doesn't make a lot of sense to me, but that's the rules. I know that's a lot. We'll get you guys a little more active in next class and doing some practice questions, but good idea to read back through this and make sure it all makes sense. If you have no questions, you are free to go, and I'll see you on Thursday.